If you are a senior citizen living in the United States, or if you have parents or grandparents who keep money in a bank account, please listen carefully for the next few minutes. There is a federal rule connected to the IRS that many people have never heard of, and it is catching completely innocent Americans off guard every single day. This rule involves a $10,000 cash transaction threshold, and in 2026, the technology used to enforce it has become more advanced than ever before. Now, don't panic. I'm not here to scare you. I'm here to educate you so you can protect yourself and your family. My name is Christian, and I've spent the past 4 years working in immigration and policy. In this video, I'm going to explain everything you need to know step by step so that a simple visit to your bank never turns into a serious federal issue. By the end of this video, you will understand what this rule is, how it works, why seniors are especially at risk, and exactly what you should do to stay safe. Let's start with the basics. The rule comes from a law called the Bank Secrecy Act, passed by Congress back in 1970, over 50 years ago. Under this law, every bank, credit union, and financial institution in the U.S. must report certain cash transactions to the federal government. Specifically, if you deposit or withdraw more than $10,000 in cash in a single business day, the bank is required to file a report. This report is called a Currency Transaction Report, or CTR. It is sent to a division of the U.S. Treasury Department known as FinCEN, the Financial Crimes Enforcement Network. Now, here's something very important. Cash means physical money, paper bills and coins. It does not include personal checks, wire transfers, online payments, only actual cash. So if you walk into a bank with $11,000 in cash and deposit it, the bank will automatically file a CTR. They do not need your permission. They may not even tell you. And there is nothing you can do to stop it because it's required by federal law. Let's be very clear about something. A CTR is not a criminal charge, an investigation, or an audit. It is simply a report stored in a government database. Millions of these reports are filed every year. In fact, recent data shows that over 20 million CTRs are filed annually. That's about 56,000 reports every single day. Most of them involve completely normal legal transactions. So if a CTR is filed on your account, in most cases, nothing happens. Now here's where things become serious. The real risk is something called structuring. Structuring happens when someone breaks up a large cash transaction into smaller amounts to avoid the $10,000 reporting rule. For example, let's say you have $15,000 in cash. If you deposit all $15,000 at once, the bank files a CTR and that's it. No problem. But if you deposit $7,000 today and $8,000 next week, you might think you're being careful. But legally, that could be considered structuring, and that is a federal crime. Structuring is illegal under federal law, and the consequences are severe. Penalties can include up to 5 years in prison, fines up to $250,000, or even higher for businesses. In some cases, the government can seize your money before you're even charged through a process called civil asset forfeiture. And yes, this has happened to real people. There have been documented cases where small business owners and everyday Americans had their bank accounts frozen, even though their money was completely legal. Seniors are especially at risk for a few key reasons. First, many older Americans grew up using cash for daily life. They are more comfortable handling large amounts of physical money. Second, they often receive cash from selling personal items, gifts from family, withdrawals from savings. Third, and this is critical in 2026, banks are using advanced AI systems to monitor account activity. These systems don't just look at one transaction, they analyze patterns over time. If they detect behavior that looks like structuring, they can file something called a Suspicious Activity Report, or SAR. What is a SAR? A SAR is very different from a CTR. A CTR is routine. A SAR is a warning signal. It means the bank believes something about your activity may be suspicious. And here's the key point. SARs can be filed for transactions as low as $5,000. In 2025 alone, over 4 million SARs were filed. That shows just how closely accounts are being monitored today. Possible changes to the law. There is some good news. Lawmakers are currently discussing raising the $10,000 threshold. Why? Because when the rule was created in the 1970s, $10,000 had the same value as nearly $80,000 today, so the limit is outdated. New proposals suggest increasing the threshold to $30,000 and adjusting it for inflation. However, as of now, these changes have not been passed into law. So the $10,000 rule is still in effect. How to protect yourself. Here's what you should do right now. 1. Never split transactions. Always deposit or withdraw the full amount at once. 2. Keep records. Save documents showing where your money came from. 3. Be honest with your bank if asked. Clearly explain the source of your cash. 4. Know about IRS Form 8300. Businesses must report cash payments over $10,000. 5. Consider non-cash options. Use bank transfers or checks when possible. 6. Get help if needed. If contacted by authorities, speak with a tax professional immediately. Important note for immigrants. If you are not a U.S. citizen, this is especially important. Financial violations can sometimes affect immigration status, green card eligibility, citizenship applications, so it's critical to follow the rules carefully. Final thoughts. The $10,000 reporting rule exists to stop serious crimes like money laundering and fraud, but the system is not perfect. Sometimes innocent people get caught in it. That's why awareness matters. If you understand the rules, keep proper records, and avoid structuring, you can handle your finances safely and confidently. If this video helped you, like the video, subscribe for more updates, and share this with your family, especially seniors, because the people who need this information the most often don't know about it.